It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne with Stephen Ingles.
Well, we're counting down to the open of markets in Greater China, and our top stories: Asian stocks under pressure and oil prices spike on reports of Iranian attacks in the Strait of Hormuz. Local media say Tehran will bar U.S. and Israeli ships under a proposed deal with Oman.
DeepSeek resumes its latest funding round with the goal of raising $8 billion to bankroll an ambitious expansion of AI computing capacity.
And we'll hear exclusively from the head of Pacific Basin after a jump in first half profit. We'll discuss the impact of geopolitical turmoil on freight rates.
Now, as you can see, it's not your usual suspects today. Don't worry, Dave and Yvonne will be back next week. But it's been quite a week, right, in terms of what we're seeing in China, not being afraid to take some countermeasures against policy that the U.S. has enacted, including for these banning of foreign robots. We've also been hearing all these developments related to DeepSeek, right? Now they are going through, it seems, with this $8 billion funding round. And of course, the developments related to Iran and Oman, this proposed deal as well, to somehow get traffic through the strait.
Yeah, I mean, obviously, this latest move by Iran, essentially coming up with this deal with Oman, it's surely not going over well in Washington, D.C., which is looking for more concessions, not necessarily doubling down and adding to the rhetoric, if you will, on the standoff between the United States and Tehran. Now, DeepSeek, we have been reporting about the second round of funding for quite some time, upwards of $8 billion. Min just on set. She'll be talking us through it in just a minute. But again, it was a pause last month after the founder, the chairman, made those comments that were
he made those waves that raised eyebrows, right?
Yes, but it also goes to the point of, the bullishness as well in the spending, and how much spending will these, lower cost models in China be willing to do without
their pricing power,
right? Their pricing power, but still without proper commercialization and monetization.
Speaking of monetization, I think the other thing that we just have to highlight to our audience members is how China's central bank is also now adding gold in Hong Kong to boost its status, I suppose, as a trading hub. And of course, this is something along the lines of what we've been seeing in terms of Hong Kong's status as a gold trading hub. And we also want to talk a bit more about the market setup for today, of course, because the memory trade is again in focus. We also have the yen. Well, it's weakening again. So let's bring in our Bloomberg Markets reporter, Anthony Stevens, for the big themes in markets today.
Yeah, it's an interesting day, right? Macro is making way to micro a little bit. So on the first board, we'll have the Japan earnings. It's a big day for Japan earnings, and moves are all over the place. And Japan has a nice representation, top and bottom, of the AI trade. So first off, we have Nintendo, which was a big victim of this kind of memory supply crunch. It's kind of punching out of that with some of the performance of its new gains. And as a big underperformer versus the rest of the market, it's seeing quite a bounce today. On the other side of things is SoftBank. SoftBank is obviously the fundraiser of choice in the AI trade globally. And some of that optimism is starting to fade, as despite beating on the net income level, investors are really concerned about how aggressive they are going forward in investing into new AI ventures while not bringing some of the existing holdings to markets, such as OpenAI. So the funding concerns around SoftBank continue to swirl, and you're seeing that in the market. Now, LaserTech is a maker of testing equipment in Japan. That shows you what happens when you miss very high AI expectations. That stock is down 12%. But on the other side of the coin, you have Resonac, much easier, clean beat, and the stock is higher. So switch the board now to Korea, which for once is having quite a quiet day. And one of the reasons for that is that the memory picture is becoming a lot more mature. Everyone knows that HBM is booked out into the far future, beyond 2027, according to some reports. But there is some pressure from consumers of memory on pricing. There's some pushback. And that is kind of net-net evening out in Korea as Samsung offsets Hynix. Now, what's very interesting is Korea started to pull off its very high volatility readings. It was trading 90 and 80 vol and has started to come off as the markets come down. And one reason for that is some of the steam coming out of upside chasing by Korean retail in either volatility or in leverage ETFs, which need to buy volatility. So this is something very important to watch going forward in Korea. Do we move away from this manic bull run to a steady grind in that market? Now switch the board again to a kind of an unspoken about dynamic in Asia, which is kind of positive. You see emerging market FX has started to move past the oil crisis here, and part of the reason for that is Korea. The Korean won has started to strengthen significantly as Korea's AI exports start to come into play. The Chinese yuan has obviously been strong the entire year, and that continues to draw flow under EMFX. And as these smaller countries begin to shake off the Iran war, you're seeing this index break out. Now, this index is, of course, very top-heavy to the likes of China and Korea. And there might be a lot of frontier markets underneath that are struggling. But for the vast majority of the money in EMFX, things have really moved on from the Iran war crisis.
All right, Anthony, thanks so much. Bloomberg's market reporter, Anthony Stevens. Well, despite reports that Iran wants to bar U.S. and Israeli ships from the Strait of Hormuz, President Trump has reiterated that the waterway remains under U.S. control.
I don't want to say it has been. It's sort of open right now. We have a thing called the blockade headed up by the U.S. Navy, and we control it. And now we control it, but they can always shoot something. They always have something or drop a mine. I think we're doing very well. I just, I'm involved in the negotiation. I think we're doing fine. It could be soon.
For more, Bloomberg managing editor Jill Deeses joins us now. So what is going on? You have one narrative coming from Donald Trump. You have also in Tehran essentially, making more demands as they do this proposed deal with Oman. And then on the sidelines of this, you have the Houthis ramping up their attacks on the Saudi-backed government in Yemen.
Yes, that's right, Steve. I think the other thing, too, to remember with some of these Trump remarks is that, remember, it was at this point, I think, more than 48 hours ago that he was saying that the U.S. and Iran would reach some kind of a deal involving the Strait of Hormuz within 48 hours. So we've once again surpassed another deadline at which, there was some sort of expectation that maybe the U.S. and Iran might at least come to some kind of a partial deal in these negotiations. Obviously, we're not seeing that. And instead, what you're really seeing, I think you mentioned earlier in this program, that idea that neither side really seems to be making concessions so much as additional demands. And I think when you're looking at this Iran-Oman proposed deal, so this, according to Iranian state media, still has to go through parliament, but essentially looking to block ships from the U.S. and Israel from transiting through the Strait of Hormuz, looking at imposing, some additional tolls or other forms of compensation on what they deem as hostile countries trying to transit that waterway, really does indicate to you that, we're not really at a place where even it looks set to return to, the state of things prior to the conflict.
How far do you think the U.S. might be willing to go, though? I mean, given these Iran demands, and I suppose all this is not being taken well in Washington. I mean, they're asking for the lifting of the naval blockade, the Iranians.
Well, April, I think there's a couple of things that you really have to consider when it comes to the U.S.'s positioning here. So first of all, there is already, outside of just control over the Strait of Hormuz and transit through there, you've got other issues that it doesn't seem like the U.S. and Iran were able to really come to the table with anyway. Particularly as it comes to capabilities involving Iran's nuclear program. So that was a sticking point at this point months ago. And that's just completely outside of the realm of conversation here. The other thing, if you're the U.S. and if you're Donald Trump in particular that you're really concerned about right now, or maybe increasingly growing concerned about, is those U.S. midterms in November, which are approaching ever closer. I mean, look, a lot of those are domestic contests, but ultimately that comes down to U.S. concerns about, U.S. civilian concerns about price pressures, inflation, fuel costs, all of this kind of things that, Donald Trump has to want to resolve this war prior to those elections in order to start bringing some of those costs and those pressures down. That's got to be something that's only growing in his mind because it's getting, ever closer.
Yep, inflationary pressures, I suppose, even though when it comes to the weight of energy in that basket, I think that pressure has been mitigated a little bit given what we're seeing out of the U.S. Brent is still at 83, though. Thank you, Jill, for walking us through all this. Bloomberg managing editor Jill Deeses. Now, when it comes to, the focus that we see today also in the tech space, as we highlighted a short while ago, Bloomberg has also learned that DeepSeek is resuming its second funding round and it's seeking close to $8 billion. Let's bring in our China correspondent, Mimi Lo. So, Mimi, what do we know about this funding round? How much interest is there?
Yeah, we don't have a lot of details. We know that Monolith Management is going to be participating in this round. Not sure who else is in the list of investors, but the first round of fundraising had drawn interest from the likes of Alibaba, Tencent, and the state fund, the National Artificial Intelligence Investment Fund. So certainly we are expecting a lot of interest in this company, which has been such an icon in the Chinese AI space, right? Especially after it launched the V4 Flash model, which was very successful, was one of the most used models for a number of weeks. And of course, a big part of the funding is going to go into its AI data center build out. We previously reported that it was planning to build this 1 gigawatt data center in Inner Mongolia. That is something that could cost tens of billions of dollars. And yes, in terms of the valuation that it's seeking, it's looking at 500 billion yuan, which is quite a step up from the previous round of 350 billion yuan.
What does essentially this V4 Flash AI model tell us about the cost performance curve and the willingness of investors? You mentioned Monolith, which is the Hong Kong-based, active investor that's backed by former partners from Sequoia and Boyu. What does that tell you as well about their appetite for continuing to pour money into the data centers and the like, and these large language models?
Yeah, so when it comes to the V4 Flash, it was launched with a steep discount, and that was what made it one of the most used models at one point, to the extent that there's this idea of the DeepSeek death zone that's been coined. So companies that are maybe less outstanding in performance, or maybe same level of performance but more expensive, they may not be able to survive. But the surprise came yesterday when DeepSeek announced that it was going to hike prices significantly. It hasn't exactly detailed how much the price hike is going to be, but it started warning clients to prepare for that move. So this is significant in the context of the fundraising. Perhaps there's a little bit more pressure to focus on profitability, because at this point it seems like many of these companies are still loss-making and it's not sustainable in the long run. But this move could be a positive for the broader sector, because it could allow other companies to follow suit and lift prices as well.
All right. Our Bloomberg China correspondent, Min Lo, thanks so much. All right, still ahead, our exclusive interview with the CEO of maritime transport company Pacific Basin after the company reported strong interim first half earnings. And of course, always at this time, we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. There's Hong Kong. Nice day. It's hot, though. Oof, it's hot. This is the China Show.
All right, true to form when it comes to artificial intelligence and these developments. We're getting developments fast and furious. Reuters reporting that Alibaba is to charge big users of its next open source AI model. So it seems like more of that pricing power.
Monetization.
Yeah, you know, we keep coming back to that.
You can't just keep on using it for free, right?
Yeah, so and it's interesting also because you look at the stock market backdrop. This is coming at the time where the southbound flows, okay, maybe a bit tentative this week, but it has been actually doing well overall in the month of July after looking quite soft for the month of May or June. If we can just pull out this terminal chart just to show you the data and how things have kind of shifted with regards to the Stock Connect and maybe some of these investments coming into Hong Kong from the mainland. There you go. So you have the numbers. Let's bring in Winnie Wu. She's head of APAC Equity Strategy at BofA Global Research. Winnie, great to have you.
Great to be back.
So what do you think when it comes to these latest AI developments, the monetization focus, and how that seems to be benefiting maybe the internet platform names a bit more? Does it help, bring that money, that rotation back into Hong Kong?
Yeah, I mean, I think the sentiment is certainly shifting a little bit. In May, early June, what we saw is extreme concentration in terms of investors' focus, in terms of the sector positioning. And that's when we saw the breadth of the Hong Kong market was nearly a 10-year low, right? Only 10% of the Hong Kong stocks were trading above the 200-day moving average. And that's usually a sign of market bottoming. Since then, in July, we see some improvement in terms of the market breadth. I think, currently a lot of investor view is that the AI rally is not over. AI is structural and there is real earnings contribution. But nonetheless, the extreme concentration in the upstream, in the semi stocks, in the memory stocks is probably broadening out. And people look at the cloud, for example, as one area where we see good revenue growth. And this monetization is a big concern for Chinese internet platforms in particular, is that can you monetize on the 2C end? And, the more success you become in your LLM, the more costly it will become for your earnings, right? That's the concern. Yeah.
So how do you see it? I mean, just to paint the picture between the A-share markets and here in Hong Kong, you're saying that tightening, focus on the AI is starting to broaden out. What does that basically mean for the second half? But in China, you're seeing that breadth sort of losing steam.
Yeah. So I think for second half, for now, second half, there are a couple things at play. Globally, what is this whole AI capex story, right? We're following the U.S. big tech companies' capex guidance. People looking at their free cash flow situation to see the sustainability of that. People looking for new monetization opportunities, right? Is there suddenly going to be some killer app or edge devices or physical AI that will drive another wave of this demand for upstream capacity? But on the other side, people also watching the Fed decision. What does it mean for cost of capital, right? Since, the capital raising for these capex is becoming more and more important. But back to China now, I think, earnings season is important, right? That's why some of the e-commerce platforms has been doing well recently, because people expecting reduce the subsidy to quick commerce, hopefully will drive better earnings. Whereas some of the other large platforms more in the media advertisement sector are still struggling a little bit, right? So, earnings season, the dynamic is very important. But also, coming back to fundamental economy, people are watching China's export, consumption data. First half, we had kind of sort of K-shaped economy, very strong external demand, weakening of domestic capex and consumption. Is there any rebalancing of that, or as of now, we seems continued deterioration in domestic?
Yeah, and we're waiting out for China trade data for the month of July, the hour after next. But talk to us as well when you look at the earnings and the expected outlook, because Steve, we were just talking about this yesterday, right? The tax issues. Yeah. Is that a headwind for earnings for companies that we need to be more careful.
We're seeing
about
developments across many different sectors.
Exactly.
It's not just one day it's one story and then the next day it's another story.
Absolutely. I think the big picture background is that China's overall government revenue to GDP, including the tax, including like land sales revenue, was 31% in 2019. That's pre-COVID. By last year, it was down to only 24%. Right, that's a combination of land sales revenue nearly halved, but also government did a lot of tax breaks, exemptions during the COVID season. But now, with this low level, government probably need to rebuild some of the tax capability. But also is that with China's golden tax phase 4, with the CRS, the Common Reporting Standard, exchange of tax information across countries, it makes the stronger enforcement become possible. So what we saw since last year, there was the VAT on gold in November last year. There was the VAT increase on telcos in January. There's talks about Social Security contribution enforcement in July, which lead to the concern on like consumers, restaurants, property management, logistic delivery companies. And over the past months, we heard the tax on individuals' offshore income, whether it's insurance or trust.
And they're trying to spur demand.
Well, it's a long-term versus short-term thing. With the aging population, you need to build up the safety network from Social Security.
Not to mention also, I guess, when it comes to earnings for companies, the export-facing ones, the renminbi strength as well. How much of a headwind is that?
Yes. It will be imbalanced. For a particular sector, the impact will be particularly strong. For example, in second half last year, for like some of the pharmaceutical CXOs, it could be as much as 7% of the pre-tax income. Also, even in first quarter this year, we saw some of the EV companies, solar companies, battery companies, some of the export-oriented tech hardware companies, they've reported significant FX losses. And typically, this will be worse for sectors which already face overcapacity and low pricing power, right?
Do you think the trend of that appreciation of the renminbi versus the basket as well as the U.S. dollars has lost steam? It's pretty much, is this as strong as it will go?
Yeah, personally, I feel like it's getting a little bit stretched because historically, people look at the U.S. versus China Treasury yield spread as a predictor or leading indicator for the RMB, and that the spread has been widening, right? U.S. 10-year Treasury is yielding like 300 basis points higher than China, so why should people own the EM currency? And also, it has been deviating from the stock market performance, so it looks like it's getting a bit stretched, especially if we see more geopolitical tensions on the trade.
And then Trump-Xi are meeting next month.
Yeah, let's see how
there's something else that we have to watch out for as well.
Yeah.
Winnie, great to have you. Thank you so much.
Very
Winnie Wu, head of APAC Equity Strategy at BofA Global Research. Now, we just brought you, of course, a bit of information related to Alibaba and how it's going to be charging these major users for its next model. We are looking at the early indications ticking up a little bit in trade. We'll continue tracking the market open. This is Bloomberg.
And welcome back. You're watching the China Show. Here's what we're going to be watching in Greater China as we wrap up this week and head into the weekend. Much deserved, right, Avril? Obviously, as we were just talking with Winnie there, the MSCI China third week of gains, we're looking at the market there, obviously with the geopolitical situation, and also DeepSeek is very much tied to that as well. The confidence as they go into the second funding round, seeking close to $8 billion. Monolith Management in talks to contribute there. It's reopening this round of funding after DeepSeek paused the process in July after leaked remarks from its founder. July trade data coming up. Trade surplus in June was $125 billion. Only 1 month on record was higher than that total. Exports expected to increase 23% after 27% gain in June. That is your agenda for this Friday morning.
Yeah, and we'll watch as well how markets open. For the moment is looking pretty flat. Tech will, of course, be in focus. This is Bloomberg.
And welcome back. You are, of course, watching the China Show, and we are counting down to the open of the markets. As you can see, some green on your screen, but also as you move over there to Hong Kong, a little bit slightly in the pre-market, a little bit down. But not a lot of market drivers right now, Avril, but we are awaiting, of course, trade data out of China, inflation data tomorrow. Trade data is a good one to talk about ahead of our next guest, of course, as well, because exports again in China expected to have gained by double digits year over year. In July, up 23%. In June, it was up 27%. So the Chinese economy is still really leaning, as they haven't been able to get that domestic demand story going, leaning on exports quite heavily.
Yeah, we'll get the inflation data out of China on Sunday.
Still
of
tame.
Course,
Still
yeah,
tame.
you know, everything looks like it might be softening. So those are the macro indicators that we're watching out for, but also earnings, right? We have those Cambricon numbers that are due later today. We'll talk about that a bit later on in the show. At a time where we have been seeing the memory trade coming under pressure, chunks in memory is slipping. We are seeing Cambricon going the other direction. Let's flip the board and take a look at what the Hang Seng is doing following that Alibaba announcement or the reporting surrounding how it's going to be charging those major users. That seems to be, you know, the trend, the direction of travel in terms of AI monetization. Of course, we also had DeepSeek, and it seems to be resuming this funding round, $8 billion worth. So, you know, it looks like a pretty good backdrop for these AI model developers. And hiking prices, pricing power is there. This is what we're seeing now for the moment in terms of the Hang Seng Tech and Baba itself also among the stocks that are looking quite soft. HSBC after the hit yesterday. Well, it's making a bit of a comeback flat, I should call it. Let's take a look as well at some of the Hong Kong IPOs. Well, one of them, this is a Zhejiang-based automobile parts manufacturer, Nascent Intelligence. Flip the board, please. Let's take a look at how it's faring. That's soaring 60+% there. Chinese oil-related names also in focus. Take a look at how things are doing with Brent at around the 83 handle. It's a bit of a mixed bag. Tracking as well what we're seeing in the copper names, given how copper has ticked higher following on what are these trader concerns about U.S. tariffs. There's a lot of stockpiling going into the U.S. that's driven up the commodity. You're seeing continued gains in the Chinese copper-related stocks. I think that's a good setup into our next guest.
Absolutely. Maritime Shipping Company. I love shipping. My dad was in the shipping business. I love it. Maritime Shipping Company Pacific Basin reported net income, interim net profit of $105 million for the first half of the year. That's up 4 times from the same period last year. Joining us exclusively now is CEO Martin Fruergaard. Thanks so much, Martin, for joining us. So, amid all this geopolitical tensions, amid rising oil prices, amid contentious debate between Australia and China over iron ore pricing, still, you're doing really well. What drove it?
Well, if you are in shipping, you are quite used to volatility, and it's actually, in many ways, also helpful for our business. It's we do provide a service to our customers of transporting the commodities, but it's also partly a trading business in the sense. So these volatilities in the market are actually often quite helpful for our markets.
What specifically did you find the biggest pocket of strength?
Oh, that's that. Well, for the company in that sense, well, we are very well positioned at the moment, and I think we probably hadn't seen all the disruptors coming, but we were sort of prepared for more disruption this year. So I think we positioned ourselves very well in the beginning of the year, and I think also our model that we have built up over many years, sort of global offices close to our customers, access to the cargoes, and these things have been sort of, the core of what we do, and then, with the right positioning, I think we've done very well this year.
It sounds also like what you're saying is that the disruptions, maybe the trade inefficiencies, the geopolitical backdrop, that's actually been good for business.
It is actually. We had a year this year, of course, when the Strait of Hormuz closes down. Volume that we trade in actually were down 6%. The ton-mile effect of that actually are down 1%. So it means that cargo disappeared because Arabian Gulf, but also because everybody was stepping back a little bit. So actually we've done less cargo in the first half, but the ton-mile, the distance you're moving the cargoes have increased because the end users had to find different sources of the cargoes. On top of that, 3% of the fleet were captured in the Arabian Gulf. Lots of congestions around, supply chains are disrupting and so on. And all these things, of course, adds value to us in the sense that goes on the freight rates on that part.
So with these profits that you've banked and given that backdrop, what are your plans? And also, of course, the high fuel costs. I know you've had some renewables as far as changing out some of the less efficient ships. What's your fleet expansion plans right now?
So today we have a pipeline of 25 ships. In it, 10 of those are new buildings, which will be delivered 28 and 29, 6 of them in China and 4 in Japan. On top of that, the remaining 15 ships are optional ships that we either have option at the shipyards or we have options for buying ships that we have taken on charter. We like the optionality, especially in a market today where the volatility, and it's a cyclical business as well. So we feel we are very well positioned. 25 ships in the pipeline, but only committed to 10 of them. The rest is options.
Talk to us about when you talk about this balance, the freight market looks quite tight. New builds are also quite pricey. How are you looking at things going forward in terms of fleet renewal, I should say?
Yeah, the view we have on it is that asset values are high. So it's actually very expensive. At least historically, it's expensive to buy the ship. So in that sense, we are a little bit careful, and that's why we like the optionality instead of the full commitment to it. The yards are full. If you want to buy a ship today, you probably get delivery in 2030. Looking at the profile of the fleet today, There's an order book in our segment, around 12% of the fleet is on order, but ships above 20 years is about 14%. So it's quite balanced, actually. And there is actually the last hike we had in the market in 2009 to 12, 1/3 of the fleet is built at that time. In 2029, they will become 20 years old. When ships become 20 years old, they become a little bit more difficult to trade. They're small, fuel inefficient, and so on. So actually, when you look at the balance of things, even though asset values are high, it looks quite balanced actually going forward.
Speaking of the order book, the flexibility is the most important thing right now with the outlook for the end of the war in the Middle East and shipping lanes and all that is unknown. I mean, there's the possibility of a perpetual war, right? So again, it comes back to having that flexibility. Again, though, how sustainable would that outlook be, given we don't know the end of the war, when the end of the war would be?
When you are in our business, disruption is just part of the game. And I think we have just learned that we have to be prepared. It's impossible to predict. We have now wars of course, we have at least the Strait of Hormuz closed. We have issues in the Red Sea. We have ships being attacked in the Black Sea. We have the harvest out of Ukraine that will not go because ships will not go into that area. We have drought, hot weather in Europe, less water in the rivers. We have Panama Canal lacking water for the canal transit, reduced draft going in. The amount of things happening right now is enormous, and we don't see that changing. We might see something. We might see Strait of Hormuz opening up again, but we also see other things coming in all the time.
What are some of these other things that also perhaps affect the future growth areas for the business?
Yeah, I think the users or the buyers of the commodities, they will have to go and find different sources to get the commodities. So this just-in-time principle now is just in case. So they have to diversify themselves a little bit on that. That's longer ton mile. We also see development in Southeast Asia. Africa is growing. Our size of ships going into these areas. There's congestion, so ships are waiting in port in Africa and so on for that. And definitely the El Nino effect is quite interesting to see. Even if Strait of Hormuz opens up, I think the gas prices, because of issues in Qatar and so on, will be high. That means that some will replace with coal, which is also what we move. So we have a world where things are now starting to... One thing happens, but it affects so many things down the line. And I think that's quite helpful for our business, actually.
From your vantage point there on the deck of the ship and in the conning tower, if you will, how do you see Chinese demand as it relates to dry bulk? I mean, I mentioned about the dispute between, like, BHP and other Australian iron ore miners, trying to find who has the right pricing power with the state body that is now negotiating. How, beyond the Middle East, how are these kind of tensions, if you will, affecting dry bulk rates?
Again, it's a little bit the same. So if Australia can't deliver, somebody else has to deliver. That will be longer ton mile. That will be good for the business. China is super important for the dry cargo because it is 40-50% of all dry cargoes going in and out of China, or mainly into China. We have been very worried about China because of the property market. We do sail with cement and other things that is actually used for construction. China again surprised us all by continuing importing more and more, but now also starting exporting more finished goods. So we move a lot of steel out of China. The steel that normally was used for domestic construction is now being shipped out in the world, and that's actually what we do, and we do a lot of that.
You also had, as we understand, a ship that was stuck in the Middle East earlier in the year. Talk to us about the impact that you saw at the time in terms of, on operations and performance as well. And given the uncertainty that Steve was just alluding to, how are you trying to mitigate some of those risks?
Yeah. So when you work for a shipping company, and we are a big owner of ships, we have more than 4,000 crew members. I think our biggest concern, basically, a lot of things are happening at the moment where actually you could say our crew gets stuck in the Arabian Gulf, but our ships are also getting crew getting hostage by the situation, and we're even being shot at around the world. So for us, the safety and security of our crew is by far the most important thing when we look at it. Then, of course, we had one ship caught in. We had it with a very good customer, and we found a very good solution together with the owner. It was a chartered ship together with the owner and the customer. So it didn't have any effect on our business. But I would say that the concern we have, of course, is, the safety and security of our crew. There's so many places in the world where we are taken hostage in a situation that commercial ships doesn't really have anything to do with in that sense.
Yeah, certainly that backdrop, I think, is something everyone is cognizant of, including for your business and, as you say, the safety of personnel involved. Martin, it's really good to see you in the studio today, talking through the outlook for the business as well. Martin Fruergaard is CEO at Pacific Basin, and we'll be watching, of course, other companies that are set to report earnings. This includes Cambricon. We'll get a sense of what to look out for. This is Bloomberg.
And welcome back. You're watching, of course, the China Show, and we're keeping a close eye on Chinese AI chipmaker Cambricon, which will report earnings later today. For what to expect, let's bring in Asia Equities reporter Charlotte Yang. What are the key things that we need to be looking out for at a time when, of course, the amount being spent on AI is in so much scrutiny?
Yeah, so I think in Cambricon's case, the key area of focus is how the operating performance has fared and then the ongoing supply chain uncertainty. So the company has actually said themselves in filing last month that they see the increase in raw material prices as a key headwind. And Morgan Stanley has actually been cutting their estimates because of these concerns over the supply chain uncertainty. And their channel checks suggest that the company is showing slower than expected deliveries for some key products. So that is a key thing investors will be watching. The secondly is what they will say in terms of competitive landscape in China, given that a lot of the Cambricon's peers has a really robust product lines into the second half of the year. So that will be another thing. But I think on the positive front is that the stock is now down 20% from its all-time high late June. As retail unwind some of their margins in these tech stocks, and also with all the love going to CXMT, so the positioning is quite light. So if they actually came up with better than expected earnings, so that could be giving some momentum to the stock.
It makes you wonder how much love there is in the Hong Kong IPO market for AI, and we're hearing, of course, for the likes of Shanghai, for example, Chinese robot maker Unitary Robotics that's seeking to raise $900+ million in the IPO in Shanghai. What do we know about the potential size, the potential demand?
Yes, so from the overnight filings, the company is selling about 40 million shares. That will be 10% of the enlarged capital. And they priced the share at around 150 yuan per piece. And so there's really a lot of, I think, interest in Unity because it's such a household name in China. So to retail investors, they've seen their robots performing, kung fu choreography on Chinese Spring New Year Gala. And also this company will be the first mainland listed humanoid robot maker. And on the fundamentals wise, unlike many of its peers that are still losing money, Unity is actually returning a profit. So they've made around $30 million last year, and they now ranked globally the #1 in terms of the shipments for humanoid robots. They also make quadruped robots, so they will be open the investor subscription on Monday, and we will get a better gauge of how the retail sentiment is from the results later Monday. So far, we don't know yet when the debut day will be, but that's definitely the hardest thing I would say after CXMT's listing in mainland China.
The robots.
Yeah. Still not AGI though. I mean, it's not general intelligence. They're still controlled by joysticks a lot, I think. So take a little of the hot air out of that hype. A lot of hype on this company.
A lot of hype, given these visuals as well that we're seeing.
Great
Human
visuals.
eye robots. Charlotte, thank you so much. Asia Equities reporter Charlotte Yang for us, and of course, staying on earnings out of the Lion City lender OCBC's second quarter profit that topped estimates, helped by strong insurance and wealth management fees. The bank saw net income rise 22% to $1.7 billion. It also reaffirmed plans to complete its capital return program this year. UOB also reported earnings in line with expectations. Net income came in at $1.1 billion, while its wealth management fees jumped almost 30% on year. UOB also maintaining its overall 2026 guidance.
Well, DBS CEO says the bank's biggest challenges over the next year will be geopolitical uncertainty and the rapid evolution of AI. Tan Su Shan spoke with Bloomberg's Haslinda Amin about how the company is optimizing its use of artificial intelligence.
So we've always said our total spend on tech will be around circa 10% of our total revenue. Honestly, that's been pretty stable and pretty flat. The irony, and I call it the paradox of token spend, is the more tokens you consume, the lower the cost. And we're seeing that tip now. And
do you expect the
we're
cost
doubling our token consumption, and we're starting to lower our costs because of the cache, the memory, the optimization, the use of SLMs, etc. Our people are getting a lot smarter on how to optimize. So that's good.
And when it comes to models, I guess the big debate is Western models versus the Chinese models, which are 80% cheaper, some say. How do you take that into consideration?
We've always been open around not being too wedded to anyone. I think we have an open architecture. That means we're not overtly reliant on any one provider, whether it's an SLM or LLM or an AI harness builder, whatever. The key is to see who's good at what. Do proofs of concepts. We do POCs with everyone, really. And we figure out who's good. And then you then figure out for yourself what is sovereign to you. What code do you want to own yourself? What sovereign code, what sovereign model, what sovereign AI harness you want for yourself and what you want to use as third party. So all this work is being done right now.
There are institutions out there which have said no to Chinese models because of the risk involved. Does that keep you up at night?
It's on whoever uses them to have your to put the right guardrails out. And we've got all our guardrails. And as I said, we're creating an AI harness, an AI control plane, so that we have the observability, accountability, and we have to patch. It's upon us right now to do that and do the right thing by our customers. So we're all over this, the cybersecurity and the use of AI to counter AI, top of mind.
3 to 5 years down the road, how do you see AI, I guess, reshaping DBS?
I think it will fundamentally change the way we work, right? And it means that workflows and work processes that we're used to in a vertical way will become more horizontal. It means that there will be things that, as an organization, you'll have to own. That's what I meant by sovereign code or owning your own code. There'll be things that you can buy, it's faster and easier, and that's fine. And things you own and you build. But what is important? What is the moat? What are your moats to keep you ahead? Because tech in itself is not a differentiator. Your own differentiation is, number one, your customer data, how well you use it. Number two, your culture, whether you have a culture of innovation. Are you fast? Are you nimble? Number three, trust. That money can't buy. But your customer trust in you is sacrosanct. And how do you protect that? So for us, it's all about making sure our data works end-to-end. You need to have ownership end-to-end from the moment the data is born to the day it's expelled from the system. Who owns it? How do you keep it safe? And how do you use it in a way that's explainable and useful to your customer? And then your culture of innovation, your people. People are telling me, the level 1 production engineering work is gone. So I'm now learning domain knowledge, whether it's wealth tech, trading tech, algo trading, whatever it is. They're learning that domain knowledge and they're upskilling to become a level 2 builder, level 2 production engineer. That means you become a higher productivity, higher order work. And that's what we're hoping, that the AI will enable the human to take on higher order work. There will come a time where customers might have their own agents interact with your agents, right? But if you're lucky and your agents are good and trusted, the customer might use your agent, right? So and then it's how you create your agent control plane, how you create your agent harness to be safe, to be relevant, and to have end-to-end accountability, to be grounded in governance and controls and procedures, and to be grounded in great data and great UX so that the customers go, I like your agent, I'm going to use it for a long time. That's when you have sticky relationships.
DBS Group CEO Tan Su-shan speaking with Bloomberg's Haslinda Amin, and you can rewatch that on the Bloomberg Video Hub. Subscribers can explore live streaming, news and interviews, all our Bloomberg TV shows, documentaries, reporter analysis and more. Check out bloomberg.com/videos. This is Bloomberg. Let's take a look at markets again. Of course, we have a number of IPO debuts, and we talked about the likes of Nascent Intelligent, right? Zhejiang-based manufacturer of automobile parts. You're seeing and extending those gains on its first day of school in Hong Kong when it comes to chips. Jiangsu X-Chip, that's also another stock that's popping 400+% against the backdrop of all this demand, especially when it comes to the likes of artificial intelligence. We also have some more earnings scorecards from Wharf Real Estate, for example. We did get a beat there in terms of the underlying profit, and that also maybe speaks to the idea of that continued recovery in property. Maybe, we are seeing further signs of that rebound. And we also had that upgrade from JP Morgan and Catalyst. There's a watch as well at Citi. So there's a lot of bullishness, I suppose, for the stock. That is among the stuffs that we will be watching. This is Bloomberg. All right, welcome back to the China Show. Here's a look at the Hang Seng a half hour into the session. We're just moving off those session lows, but you're seeing that continued pressure on the benchmark on a day where you have the biotech-related names. Those are the ones in the corner, in the green, but we are seeing the internet platform ones continuing to come under pressure. And of course, we are still digesting some of these lines coming through from the likes of reportedly Alibaba and how it might be looking to charge these major users of its Nix Quen model. So more monetization efforts, I suppose. Of course, that DeepSeek thing, right, Steve? That's the other thing that we'll be talking a little bit more about. Just in terms of the sectors today, we are still seeing Hang Seng Finance, Hang Seng Property. Those are the sectors that continue coming under pressure. But for a look at what else is happening, Bloomberg Markets reporter Anthony Stevens is here for the big equity themes he's seeing across the region.
Yeah, let's talk Korea very quickly. There are only two major stocks in that market that really matter to the whole world, and that's Samsung and Hynix. And there's been a big spread between the two. As Korea has come off a little bit, Samsung has started to outperform Hynix, and that's showing up in a really big way today as kind of tech waves across the region. Just flip the board and you can see how far that trend has to reverse. So Samsung has underperformed Hynix for years as the AI bubble kind of got going, and now that's starting to turn around as Korea kind of runs out of steam. Samsung is a much more defensive play because it has the foundry business and it has the phone business. And most notably in the phone business, Samsung's foldable phones are seeing very big demand. They're up around 30% versus the previous model. So this spread may have some significant room to go. Now flip the board again to Japan, where Japan is having one of its largest earnings days of the year, and there are some massive moves all over the place in presumably defensive sectors. So the pharmaceutical sector with M3 and Fujifilm are seeing the biggest moves in history on earnings misses. This space has started to slow markedly in Japan from both a growth and earnings perspective, and it remains to be seen whether investors will stay with it. On the tech front of things, you have Lasertech and JX, Two big outperformers on the year, struggling after earnings. What is the remaining upside from these teams around chip materials and chip testing in Japan as Chinese competition starts to come online? JX is also in the cabling space, which of course saw that kind of controversy around the US curbs on Chinese cable and optic names. So that space is very much in focus here, and this kind of volatility on the downside will really stress investors. Now switch the board again to maybe some outperformers on the China tech side. And you see Chinese LLMs really standing out against the weakness of the overall Asian tech space. I'm sure Rob Lear will have a lot to say about that. But for now, investors are chasing Chinese LLMs in the southbound connect as they become available. Minimax was the top bought name in southbound yesterday, which is quite an impressive achievement for a company that is really that small.
Look at those gains. Zhipu up 10%, Minimax 13%. Yeah, Robert Lee will have something to say about that. Anthony, market reporter, I should say. Thanks so much for that. Let's then segue a little more smoothly than that to a roundtable to talk about DeepSeek. It's said to have resumed its second funding round. As it looks to raise some $8 billion in a bid to fund its data center expansion. For more, as I promised, let's bring in our team, China correspondent Min Lo to my right, and Bloomberg Intelligence senior analyst Robert Lee over there to my left. Let's begin with you, Min. How much interest is DeepSeek getting for this upwards of $8 billion round of funding, which was delayed from June?
Yeah, I mean, you just look at the valuation. It's seeking a valuation of 500 billion yuan. And just in June, it has secured a valuation of 350 billion yuan. That's a big jump. And it shows you just how much investors' interest there is in this company for there to be such a big valuation jump in just a matter of months. And we understand that Monolith is one of the contributors to this round of fundraising. The previous round, they had secured funding from Alibaba, Tencent, and a state-backed fund, the National Artificial Intelligence Investment Fund. So yes, a lot of interest for this company, particularly after the successful launch of the latest V4 Flash model, which was the most used model for 7 consecutive weeks on an API aggregator. So, and of course, a big part of this is thanks to the aggressive pricing as well of its API tokens.
Yeah, price hike, right? So talk to us, Rob. I'm sure you have a lot to say about this.
You should see his facial expressions on camera.
Let us have it. Tell us what you think.
Okay, so don't call me man of 1,000 faces. So just refer back to my reaction to the very strong opening price rises we've seen at Minimax and Zhipu. So why am I slightly surprised? Well, I'm not surprised because, as Anthony said, I think Minimax is now open to mainland Chinese investors to invest directly in Hong Kong listed stock via the Stock Connect. And as we know, retail investors have a lot of risk appetite at the moment, as we saw in Korea. So, you know, to some extent, the cavalry has arrived. In my mind, you know, it's a liquidity-driven gain. It's not driven by fundamentals. I'm not saying these stocks can continue to go up, but they are the perfect definition of a high beta retail darling. Fundamentally, there remains big questions about their ability to break even, let alone break into sustainable profit.
Well, my next question is to both of you. We'll start with you, continue with you, Robert. As far as pricing power, it seems like a number of these models, how far can they go without raising their prices? We're already seeing DeepSeek raising their prices. The news today was Alibaba and Quen is going to be raising prices to its top-end customers. Is this sort of an inflection, turning point for these supposedly bleeding large language models?
Yeah, definitely over the last couple of months, you've seen an increasing focus on monetization in the sector. So if you cast your mind back, I think in June, ByteDance, which has been quite late to the market, but as ByteDance normally is hyper-aggressive. So they actually introduced subscription plans on their Doubao model. So an increasing focus on monetization, price rises, you know, to state the obvious, has to be a good thing. But API services, so these are token engines, if you like, in crude terms, are still a loss-leading service in the China market. And DeepSeek yesterday said it was going to introduce significant price rises, but it didn't actually give a number. And what we know at the moment is that their current pricing is amongst the lowest in the sector. So will that price rise bring them up to a level where they're actually covering the costs? Given the intense competition in the market with over 988 large language models competing against each other in China, I would actually doubt that they would cover their costs. And also, how are the competition going to react? Because again, in a market that is, the definition of cutthroat, are some of the others going to say, right, we got the balance sheet, bring it on, we're going to cut prices? It's quite possible. So we'll see.
I think you've also raised the point previously that when it comes to the competition, it's almost even starting to resemble the solar industry, right? That's very interesting as well. Talk to us about what we know from the Alibaba reporting.
Yeah, the Alibaba story is quite interesting, right? Because it's a new model of charging customers for using their open source model. So what typically is done by these open source companies is that they allow their models to be free to license, free to download. And if you host them in your own platforms, it's entirely free. So the only way they get money is if you use them on the cloud computing platforms like Alibaba, then you pay a token fee because then it's charged as a model, as a service. But now Alibaba, according to Reuters, is following in the footsteps of Moonshot AI to charge users that license their product, especially if they are able to earn at least above $20 million a year in revenue by offering let's say the Kimi K3 as a service. So that's what Moonshot AI is doing. So Alibaba is said to be looking at a similar model. So if you license their model and you host it yourself, but you generate more than a certain amount of money, they can ask for a certain percentage of your revenue. So this is quite a game changer because the argument has for a long time been that the proprietary models are very profitable, but then the open source models, we're not sure how they're going to survive in the long run. So this is a new sort of channel to get back some money.
Robert, what's it going to take for you to turn less bearish on this whole sector? It's further consolidation. I mean, consolidation, not further. Consolidation.
Yes. Within the China context, there has to be consolidation with nearly 1,000 competing models. So that's a very obvious point. Second thing is price rises. So, yes, increasing focus on monetization. I would say maybe what we're seeing at the moment are baby steps. We need to see more serious and more significant price rises to the level that these companies are at least covering their costs, which we're nowhere near at the moment. And then finally, we need to see AGI, which I think remains a long way off. There's no evidence that we're about to, have a breakthrough on AGI. And we need to see killer apps. I mean, what is a killer app? WeChat within a China context, or Weixin, is the definition of a killer app. A piece of software that is essential to your daily life, ubiquitous in use. You can't survive in mainland China without it. Where are these AI killer apps indeed? What are they? Because by and large, aside from the models themselves, AI is being used to augment current software. So that's a positive, but companies are not successfully monetizing on the back of that. Okay. So we need a new generation of AI products, whatever they may be. We need to see those three things. But at the moment, on an aggregate basis, we expect the China AI sector, ignoring the semis and hardware names, to remain deeply loss-making for at least the next 3 years because of the intense competitive dynamics and the ongoing struggle, as Min Min said, in a market where the vast majority of tools are available for free. Monetization remains very, very limited.
At least are we getting a bit more of a sense of the business model that these AI model developers seem to be converging towards, just based on what we're hearing from DeepSeek, based on what we're hearing potentially to come from the likes of Alibaba?
Yeah, I think the other thing as well, DeepSeek's price rise, as I meant to say, is interesting. Again, what Min Min said around their fundraising. Will we see an IPO later? We'll have to wait and see. But yes, I think agentic AI use, which has really been exponential, which is great in terms of demand. The cloud companies are definitely benefiting it. But again, they are consuming a huge amount of tokens. And as I've already mentioned, tokens are priced at a loss at the moment. So again, if we look at our friends at Jupu AI or 2513HK, their loss is actually blowing out on the back of this. So based on consensus numbers, they're going to lose around $700 million this year, and their operating loss will actually widen next year. So again, going back to my initial reaction on what Anthony said, these companies are not yet on a stable commercial footing, and their route to that and long-term profitability remains distinctly unclear. I think that is a very rational, balanced view.
Okay, so it'll take a while for you to change your mind. We will watch this space, Rob. Thank you so much. Robert Lee, our Bloomberg Intelligence Senior Analyst, along with our Bloomberg China correspondent. Min Lo, thank you so much, both. Now, we've also been checking and tracking some of these macro indicators, of course, from the likes of the Philippines, and we've seen how, in terms of the second quarter growth, it has missed the mark versus consensus. We were expecting somewhere around 2.9% of growth. It came in at 2.3%, and this is actually the slowest pace since 2009, so even worse than pre-COVID era. The finance chiefs or the Philippine authorities, I should say, are talking about still how they are looking to accelerate implementation of infrastructure projects still. Against the backdrop, of course, of how we're seeing dollar Philippine peso still around the 61 handle. And of course, we've been seeing it not far, really, from those record lows, the weakness in the Philippine currency. Steve?
All right, well, SoftBank under pressure. Despite its first quarter net income beating the street, analysts are concerned over the funding of its growing AI projects. Details are next. This is the China Show, and of course, we're on Bloomberg.
All right, welcome back. Now, as far as the Philippines is concerned, we are still getting some of these updates from the Secretary of Social Economic Planning, talking about how the Middle East conflict, El Nino, that could weigh on recovery. Of course, the second quarter GDP print growth missed the mark. I should also clarify that when it comes to the Philippine economy, it actually grew at the slowest pace since 2009 if you exclude the COVID year. So something else that we're watching as we watch the dollar versus the Philippine peso.
Yeah, GDP up 2.3%. Estimate was 2.9, so they missed quite a bit second quarter year over year. Well, SoftBank posted a beat in its first quarter profit with gains from its Intel stake and a rise in the value of ByteDance, helping offset weaker performance elsewhere in its vast portfolio. But the focus for investors remains on its growing exposure to OpenAI and when those AI bets will begin to translate into meaningful returns. Oh boy, we're wondering that all across the world. Bloomberg Intelligence Asia Telecom senior analyst Kirk Boudry joins us with more. Why are markets so disappointed in these results?
Yeah, I mean, because it was a good print, right? I mean, they're an investment company that's publicly traded. So having investment gains and net profit, always good.
Always good.
I think one of the issues, though, is, they reported record net asset value at the end of the quarter, but it's already come down. And investors can look at that every day. And so things like the balance sheet, like how asset value compares to the lending they've done, those measures get worse when asset value comes down. The other issue is liquidity, because they have a lot of commitments for investments, and they're about to embark on a very sort of asset-heavy investment program for data centers. And markets want to know how they're going to pay for it. And when SoftBank reports results, usually there's a lot of qualitative discussion, and everything was very light on the details this time. So I think investors are generally disappointed.
Yeah.
And markets are worried about the balance sheet, you're saying.
Yeah, yes. I mean, so at the end of the quarter, when they talked about like where their valuations were and the money they borrowed, they said their loan-to-value ratio is 13%. And that's where it was a couple years ago before they became very aggressive about investing. And so that's good. And you think, all right, that's great. But if you calculate it now, it's closer to 18 to 20%. And 25% is a level when people start to get worried. So you've already sort of spanned half that distance.
So what should investors be, and what are they going to be looking for going forward?
Yeah, so, I mean, liquidity is important. So there's a couple things that are worth keeping an eye on. And one of them is the timing of an OpenAI public listing, because they can monetize the existing stake they have. They can borrow against it. Announcement or concrete details on that would be the best for SoftBank shares. Another issue that's related but maybe not as sort of large is the closing of a deal that they made to buy ABB's robotics business. Because once that deal closes, then they have the potential to monetize all of their robotics assets through another public listing.
Okay.
Kurt, great to have you. Thank you for running us through some of these investor concerns as we also watch out for that open AI development, right? That's something else that markets are paying attention to. Kurt Boudry is Bloomberg Intelligence Asia Telecom Senior Analyst. Now, of course, when it comes to AI demand, Steve, it's been very interesting given how intense that demand is. Chinese tech firms from ByteDance to AI startups, they also seem to be driving demand for Hong Kong's data centers. And that seems to be pushing up leases here in the city as well.
Well, the leases for these data centers by the big players in China that can see Hong Kong playing a role as a conduit to sell their products as well overseas. The hyperscalers using Hong Kong as a springboard to test models and to export overseas. But lease prices are up by nearly double this year. So, Hong Kong, likes to tout itself as having somewhat of a renaissance post-COVID, post-protest. This is one slice of that on top of the story we had yesterday about expats returning to Hong Kong. So obviously, Hong Kong, not necessarily known for its big tech prowess, but it is in the AI data centers right now for Chinese.
Yeah, and it's also been seen as a gateway of sorts, right? So there are these advantages versus the mainland. You think about the free flow of data access as well. So again, going back to your point in a way on what we're seeing on that gateway, so to speak, that extends even to data centers.
Sure. So it's a fundraising place for these AI players, no doubt. That is the bread and butter of Hong Kong, but also can play that infrastructure role.
So what are we watching out for as well coming up next, Steve? Because you can get all that insider's guide, right, to the money, the people, shaking up the finance hub as well in the Hong Kong edition newsletter that's coming out on Thursday. And if you'd like to check it out, please do sign up by scanning the QR code on your screen or via Bloomberg.com/newsletters. This is Bloomberg.
All right, welcome back. Sequoia Capital says situational awareness has invested $400 million in a company it has backed. Sequoia partner Patrick Grady also telling Bloomberg that Leopold Aschenbrenner had approached the firm about taking over some positions.
It has been reported that we were talking with them about the Anthropic stake. King Griffin showed up with what was a better solution for Leopold at that moment in time, and he went with the better solution. I think that our observation is that there is this game on the field over the last couple of years investing in the AI supply chain. Leopold was one of the first people to recognize that that was the game on the field. And on balance, he played it pretty darn well. And so our suspicion is that he's going to be a fixture in Silicon Valley for a long time to come.
I wanted to get to the Valar case study. We've talked a bit about Sean.
Please
go ahead. Yeah.
On situational awareness, he did just wire $400 million to a company that we invested in. So.
Oh, we actually reported on the $400 million, but I haven't got a clue who the company is.
Yeah, no comment on that. But he's not.
It's a good one.
He's not. He's going to be. He's really good. He's going to be around.
Now, on the topic of Anthropic, they also acknowledged the firm was behind the curve on the AI startup. Sequoia eventually agreed to invest $2.5 billion in the company.
This is the tectonic shift of our lifetime. In a perfect world, we would have backed Anthropic many years ago. We didn't. And so the best thing we can do now is to come in at the most scale that we can muster. And so $5 billion was kind of a theoretical number mentioned to be provocative. We ended up at 2.5 because we can't really do $5 billion across all of our different funds, and so 2.5 is kind of the most we can do, and that's sort of how we ended up with that number.
Is it fair to go as far as to say, how much money can we deploy without putting the firm at risk?
Yeah, that was part of the conversation. 2.5 or 5 would be comfortable numbers as far as that goes. But one thing, we've never done SPVs. We're not in this SPV business where you speak for something.
I think we have enough time today to talk about SPVs.
Yeah, so we don't do that stuff. And so $2.5 billion was what we could do out of the core fund's committed capital.
Yeah. Let me ask you this, or give some background. Growth, early stage. Since 2017, you've led the growth, You've co-led early stage, but SaaS, consumer, but there's a lot of overlap, right? You have made significant growth stage investments and joined boards. You've made early stage investments, particularly in AI. Just talk a little bit about how the two of you see that progressing, forward looking.
I think it's very, very simple, which is like if you've been in this business a long period of time, you know what a good early stage investment looks like. You know what a good growth investment looks like. So Pat has been traditionally a growth investor. He made the early investment in Harvey. I've seen how early stage companies grow and advocated for growth investments in Airbnb and DoorDash when they grew up. And over time, I think if you've been in this business long enough, you'll make both early investments and growth investments. We have Constantine that championed Citadel Securities and Waymo. Yeah. We talked about Shan. We have David that has invested in a Neolab that's relatively early. We have Sonia, who's recently sort of flew with me to London to advocate for the investment in Ineffable. So our team is much more fluid, and we don't. Just going back to like most of our partners don't like being put in a box.
It's 11:29 a.m. in Tokyo. Japanese market's going to break in a minute. Of course, the things we're watching, following on from SoftBank earnings, there are a lot of companies, and I say a lot, I mean a lot, 700 plus of them, Japanese companies that will be reporting today. Let's take a look at how markets are faring just 30 seconds before we head into the lunch break. It's a down day. There are these continued concerns about the initial over-exuberance when it comes to the AI trade. So that stumble there, of course, when it comes to the focus as well to the likes of SoftBank. Keep in mind, though, you're seeing on the broad-based level, the topics is looking quite flat. Of course, we have been watching the upward pressure on JGB yields on a day where you look at dollar-yen. Wow, it's like that intervention didn't happen. Well, it did help bring things down from 164, but we're still sitting above the 158 handle. Let's also bring in our Bloomberg Chief Asia FX rate strategist, David Finnerty, for more of this. So, David, tell us, where's the yen headed?
Well, certainly, if you ask traders, there's definitely no consensus at all. Obviously, look what happened. If we look at the plays earlier this week when dollar yen went down to 155.23. Certainly, hedge funds were quite happy to jump on that move with all the rhetoric coming out of US from Scott Basin and Japan. So they jumped on that move. They covered those positions above 155, and now basically he said we've drifted back. We're back up here. We're at 158. There's no real conviction at the moment because there's obviously still worries of will there be more intervention. There's still the underlying trend of dollar yen higher. That hasn't changed. And, of course, you have US payrolls at the moment. So if you look at positioning that's going on, I was trading some traders yesterday, and one guy goes, look, the market's cautiously long dollar yen, but he goes, there's no real conviction on this at all. And you are seeing people play both ways. Some people in options have done some downside trades, so there's a bit of upside interest. But a lot of people are just on the sidelines because they're going, look, let's get payrolls out of the way, see where dollar yen goes. Now, obviously, even if it's a strong payroll data, some people are going, okay, it rallies, but then does it rally back into intervention territory? And then they come in on Friday and sell it down again. So the market's very jittery about this data. So wherever it goes, basically the market's unsure, slight bias towards upside, but very, very wary that intervention could come and potentially come as early today if, dollar yen does get a good boost from the US payroll data.
Well, if intervention momentum is sort of petering out, you mentioned that there could be more intervention, but really what other tools would we be looking at, either from the BOJ or the Ministry of Finance?
Yeah, I'll be honest, the catch is they really have a limited amount of tools at the end of the day, and whatever they've used, and remember this time we had aid from the US as well, so the double whammy there, and the fact that dollar yen is back above 158, it just says a lot to the fundamentals. You can say it shouldn't be there, the market's going, but it is, and it is there because we think it should be there. So I think whatever tools they use, and rhetoric obviously is not enough, we're questioning whether intervention is even enough. The reality is that the market is so big and deep. You are fighting this wave of basically buying, sentiment saying, well, we do think it's going to be higher, but we're very wary that you're going to try and push it lower. but the market sentiment is we think it should be where it is. And because the market is so big, you know, we saw recent intervention, data came out today, that back in April, Japan basically intervened with nearly 40 billion in one day on April the 30th, and it intervened again afterwards, and yet here we are, we're back here again. So at some point, its impact gets smaller and smaller unless you do bigger and bigger interventions. But at some point you go, look, we're just fighting it here. I think with the help of US, it certainly helps them. But again, the reality is we're back above 158. And if you get a strong payroll data today, at least your knee-jerk reaction, you think will send it above 159 towards 160. And again, the market will be very wary of further intervention. But the market's basically going, look, that's where it should be. So to fight it is a bit of a futile battle. And that's what history has shown us.
Dave, thank you so much for talking us through what's at stake for the Japanese currency. Bloomberg's Chief Asia FX Rate Strategist, David Finnerty. Now, of course, we're also getting in dollar terms China's July exports data. And, of course, for the exports, we are seeing that rise of 23.9%. This is an on-year figure. So better than expected because we expected it to come in at around 23%. Now, in terms of the imports number, it's a rise of 27.5%, so a bit of a missing of the mark. It's a bit of a mixed picture, and of course, a couple of days from now, we'll get CPI and PPI data out of China as well. Let's bring in Xiaojia. She is Chief China Economist at Crédit Agricole. Xiaojia, great to see you, and great timing as well, because now we have the dollar terms for China trade data. What do you make of the numbers and the extent in which this represents that continued strength in the AI boom demand that we're seeing globally that supported exports? What do you make of this?
Yeah, I think the exports continue to show very strong resilience of these Chinese exports. 23.9% is confirms our expectation, roughly in line with the consensus forecast out there. I think certainly the continued strong demand for AI infrastructure and the capex continue to support related supply chain trade that would benefit Asian exporters as well as China. So I think if we look at the first half numbers, clearly these intermediate inputs and related equipment from China has been continued to grow very strongly for the Chinese exports. So in June, for example, those chips and also computers and memories, storage, etc., those jointly contributed more than 30% of China's headline growth. And on top of that, there are certainly, because of China's export competitiveness in those green-related products at the time when we still have these ongoing uncertainties in the Middle East, certainly help China's related export items in that front as well. For example, if we look at auto, those EVs and hybrid cars, they continue to likely to be recording quite strong growth on that front. And also China's transportation like ships has been very strong as well. I think on top of that, if you look at the base effect, if you look at these U.S. tariffs that was imposed back April last year, so that set a pretty low comparison base for China's exports as well. So that could help a bit. And also there has been some of the, I don't know, maybe the extreme weather conditions that make the weather this summer extremely hot, and that could support China's export of those air conditioners and
El Nino is real.
Home appliances, right?
So we're just getting the Chinese equivalent of the export numbers, a little bit below the expectations, but still double digits for both. Exports up 17.8%. I think 5 out of 6 months, 6 out of 7 months now in double digit. Imports have been in double digits every month so far this year for 7, but both were below the expectations, which kind of brings to the question about what's the outlook for the rest of half of the year if the appreciation in the renminbi versus the dollar in the first half was about 2.9%, nearly 3%. But it seems like that momentum is slowing. Maybe the weaker yuan will help exports further. Will you continue to expect exports will lead this pillar of the Chinese economy while domestic demand remains weak?
Right. So I think in terms of exports, if you look at even the top engine has been AI-related tech trade, they're less sensitive to price changes. Like especially if you are talking about China's FX appreciation 3% against US dollar, appreciation 4% in basket terms. Right. That compares to if you look at these ADP and the chips inflation, is a very minimum number. So I think what we have seen from the PBOC and the Politburo is that the policymakers in China seems to be quite comfortable with the CNI trend so far this year. So in Politburo meeting, actually, there was no mentioning of FX policy at all. So I think policymakers, they have the willingness to continue to tolerate the CNY strengths as they remain quite confident in these export competitiveness, and then they stay focused on these long-term trend, for example, developing domestic industries, upgrades, and strengthen these China's positions in the AI race. So I think China has shown is a willingness to anchor CNY. So at a time when we have seen a lot of FX volatilities out there, so I don't think CNY like exports, how much more it could grow in terms of exports would be a key input for CNY. But of course, domestic demand is very weak.
Yeah.
So
I was just about to ask, so when it comes to the AI boom and how that's helping exports, at which stage do you see that helping to trickle through in the rest of the economy and support consumption, if at all?
Yeah, I think clearly, China is trying to buy time and wrap up its investment and its push in terms of fostering the growth in those AI and technology-related development, and continue to support the development of those emerging and the future industries, in the hope that they become so significant enough to fully offset those drags from the previous so-called old economy, the property drag. But it takes time. So if we look at these easing measures or policies that are coming out of Politburo, is still very supply centric and with quite I would say limited signals for stimulus in a major way for demand. So I think that would so now if we have seen all these rapid AI development, but would that translate into better wage growth, better in household income growth? I think is quite limited outside of those AI-related wealth effect that comes in through the equity market that have some quite contained impact for those people who are participating actively. So I think that sets a dilemma, and also we think that this would also suggest that apart from those AI-related inflation and those reflation because of these global supply and demand, underlying domestic demand and the reflationary pressures and the inflation expectations in China is likely to continue to be quite mild.
Yeah, because we're going to get those inflation numbers as well tomorrow, and not expecting too much, about 1% for CPI. PPI's pricing power at the factory gate has been much stronger after 41 straight months of declines, right? So at least they have pricing power there. A lot of that tied to the AI, components. But I just wanted to broaden it out a little bit more about the news flow between China-U.S. relations of late has been about some more tit for tat on various products and this and that. How do you see this when we're just a month and a half away from the meeting between Xi and Trump, at least scheduled, in Washington, D.C.? Does this have the risk of derailing any progress that the two have made?
Yeah, certainly I think the recent ongoing introductions of those investigations and new tariffs that has been imposed from the Trump administration and China's retaliatory measures would raise the stakes for the highly anticipated meetings taking place in late September. But so far, if we look at China's response, it has been relatively retained. So it's about the diplomatic warnings and about targeted retaliations. So certainly we will have to see how this play out. But China, I think this not only, I think China becomes a little bit more frustrated by how unpredictable these U.S. trade policies has been. And I think they feel very frustrated as well, because just back in May, Presidents Trump and Xi, they are calling for building up these strategic, constructive, stable relations. So I think China also send some signals they are willing to retaliate more if U.S. further pressurize on this. But so far, I don't think this will completely, rule out these policy, these meetings in between those presidents. But we have to see these coming 1.5 months definitely are very critical.
Yeah. Frustration just leads to bargaining power. I think the Chinese are pretty well aware of the Trump administration is unpredictable, right? So that's a good precursor going in to negotiations ahead of the meeting. Thanks so much. Xiaojia, Chief China Economist at Crédit Agricole. Thanks so much. Coming up, Macau's casinos may be running out of luck as a China crackdown rattles high rollers. Details in a few minutes. This is Bloomberg. All right, well, we're watching shares of MGM China after it reported adjusted EBITDA for the first half year that came in at $613 million, just missing expectations. Revenue grew 4% to $2.23 billion, but the company saw its net income slip 20% from a year ago. Yeah, so these Macau casino stocks are in focus because the companies have been facing their sharpest setbacks since reopening from COVID, and the gambling hub has been hit with steeper than expected revenue declines in June and July as China steps up efforts to stem capital outflows. Bloomberg conglomerates consumer and gaming reporter Shirley Zhao joins us now. So Shirley, talk to us about how much this was because of bad weather and the World Cup related distractions, and are we expecting more of that softness to come, or do they have a shot at recovery?
Yeah, we've seen a significant slowdown in Macau's gaming scene in June and July. And there is a mixture of reasons. And the most cited one would be World Cup diverting gamblers' budgets. And of course, there's bad weather. But what the market is most focusing about and what's the most concerning is that this slowdown coincides with China's acceleration in cracking down on wealth. So since late May, China has launched a series of moves cracking down on, for example, taxing overseas assets, overseas trusts, and cracking down on cross-border brokerages. And that's created a really weak sentiment among the high net worth and wealthy people in China. And, once they feel they don't want to spend that aggressively anymore during this period, that's affecting Macau's gaming revenue. So how does that translate to the impact on the operators, whether it's Las Vegas Sands, of course, Melco, Wynn, Galaxy, and the like? Yes, we've seen from the casino operators that have announced their results so far, both Sands and MGM have reported quite significant drop in their profit margin. And that's what the market is worried about, because if the gaming revenue growth has slowed down, but the operators have to keep their costs to retain the sort of big gamblers, because they have to spend on freebies such as free hotel rooms, concert tickets, as well as commissions and rebates to attract these big gamblers to Macau. Then how are they going to maintain their profit margin? That's one of the biggest concerns for the market. Right.
So how does the outlook look like for the rest of the year?
Yeah, so the analysts' estimate for Macau's gaming revenue for this year has already been dropping. So the latest estimate for the gaming revenue growth for 2026 is 3%, which is marked cut from 7% at the beginning of this year. And August, which traditionally is a very strong month, and this month, August should benefit from the pent-up demand after World Cup. So if August's performance is in line with analysts' expectation, then people may have more confidence and people may say, oh, the slowdown is just temporary. But if August's performance, again, is quite weak or not as good as analysts expected, then people may have more to be worried about.
But if they're going against the policies of Beijing, that's a big headwind, obviously. They do have the NBA games coming up in a month,
yes.
on September 9th. Yes. Okay, that's Bloomberg's conglomerates and consumer and gaming reporter Shirley Zhao. Plenty more ahead. You're watching Bloomberg, of course. You're watching The China Show. Welcome back to The China Show. North Korea's Kim Jong Un may be isolated politically, but Bloomberg Economics estimates his family raked in as much as $22 billion between 2022 and 2025, despite a slew of sanctions. And that economic boom is in focus of a Bloomberg Originals documentary. Here's a preview.
North Korea. It's a bit of an enigma. A sealed-off society on the doorstep of a global superpower. A minuscule economy, but a nuclear arsenal that commands global attention. And despite a mountain of international sanctions designed to crush it, the Kim regime has begun to thrive.
The entire North Korean government is in stronger position than at any point over the last 35 years.
Following a brief surge in 2016, crippling UN sanctions and pandemic lockdowns sent the economy into a prolonged slump. But by 2023, something changed and the regime oversaw rapid GDP growth.
North Korea's trade and overall regime revenue sources have shifted significantly. A rich North Korea has the potential to be a much larger threat.
If the world once viewed Kim Jong Un as the lonely dictator of a hermit kingdom, his recent schedule tells a very different story.
This is an amazing comeback story for leader Kim Jong Un. We're seeing Kim more powerful economically, militarily, politically than ever before.
His newfound cash is funding a massive military buildup and the Kim dynasty for another generation, potentially in the hands of his young daughter. So how did one of the most isolated, heavily sanctioned regimes on Earth pull off a multi-billion-dollar economic turnaround?
Subscribers can watch that documentary in full right now on the terminal and on Bloomberg.com. It'll be up on the Bloomberg Originals YouTube channel a little later as well. And Steve, just before we head into the end of the show, and it's supposed to weekend, right? A couple of things that we're watching for the weekend, which include those Chinese inflation numbers, CPI, PPI, that is due as well. We heard from our analysts earlier expecting a subdued print. Not just that, you have the U.S. payrolls, you have the dollar consolidating ahead of that data. That is in focus. And then next week as well,
a lot of earnings.
A couple of big ones, including Tencent. So that's what we'll be watching as well this weekend and into next week. You're watching The China Show. Thank you so much for your company this week.
Have a great weekend.
Have a great weekend. This is Bloomberg.